Welcome to the Big Fat Real Estate Checks podcast with Marco Kozlowski, where we help investors like you get the knowledge and skills you need to replace your JOB with passive cash flow for life.
Hey everyone, welcome to Big Fat Real Estate Checks. My name is Marco Kozlowski, and I'm here with Francesco Galluccio and Gabriel Araiz. And we are fresh out of Vegas. We just went to Vegas for 4 days. Feels like a month. We did a lot in a very short period of time.
We did.
Celebrated Frank's birthday. It was a lot of fun. And we connected as men and actually got a lot done. And I think we really accomplished a lot while we were there, and just had a really great time. It was a lot of fun, and really glad that we did that together. And so if you're just stumbling onto this podcast, wandering aimlessly, wondering what this is all about, this is a podcast all about delivering as much value to you as possible, showing you how to buy cash flow correctly so you can buy it correctly at the best possible price, allowing you to make the most amount of cash flow in order to really take care of your family forever and create generational wealth at the same time. Specifically now, as inflation is very high, you're buying at today's dollar for tomorrow's extremely higher prices, allowing you to even make more cash flow as things go up in value. So, and never using your own money, of course, because we're using asset-based lending. So if you have not listened to the first 10 episodes, please stop now. Stop it. If you're still listening, stop. Are you listening? No, go back to the first 10 episodes, listen to those. Explains exactly what asset-based lending is, so you don't need to use your own capital, not because it's get rich quick, because you're using skills instead of money, just like the wealthy, to never have to use your own money again, just like we all have to build a significant amount of wealth to take care of our family, our loved ones, and each other. And we teach this. So please like it, love it, share it, subscribe. I know you're going to love every single episode, and there's a lot of value here. So today, I believe we're going to discuss something that I thought maybe we had discussed, and we're still scratching our head wondering if we really nailed this topic. But it's around establishing the right value at the time of purchase with the seller. So really making sure that we're both on the same page as to what something is worth, because many sell based on a pro forma future value, which I think we've discussed we never do, or a business model that is not necessarily something that we do. For example, I've seen assets that are for sale, single-family properties that have an Airbnb in it, and they're selling the business of Airbnb, which is a much higher value than the asset of the property itself, and which is fine, but you're paying a lot more for the property than the value as the business of Airbnb, and we're going to discuss all this. So there's a lot of different, financial structures and different values based on those financial structures. And of course, the objective is to buy it for the best possible amount so you can make the most amount of cash flow. So we have to be careful as to how we evaluate things so you're not caught in a trap or overpaying for something based on belief that might actually bite you in the ass later. So let's tackle this topic. Who wants to begin?
Well, I can start, because I think we should maybe go back or go over how do you establish value at the onset, because there's always a process of you doing your own value establishing before you even get to the point of a negotiation or discussing with the seller, and that's kind of your own apple to compare to their most probably bananas. So, we covered residential where, and this, I think you mentioned the Airbnb, Marco. It's going to be, we'll find a relationship here where a house is going to be, valued based on the comparable sales, the prior comparable sales. And that's going to be true for house, duplex, triplex for the most part, and 4 units as well. So if you're looking at that, and there's an Airbnb model, for example, the reason the Airbnb model, Marco stipulated that it could have a higher valuation, is because the seller is using economics to justify higher valuation. They're using numbers, when that type of asset class, which is, a house, a duplex, triplex, should be compared to prior sales. Based valuation would be on comparables, not on economics. So that's one of the disconnects. So you be careful not to make that mistake, because that's how you take a bath. So that's in terms of the Airbnb, I just wanted to make sure that was clear for someone who maybe didn't listen to the prior podcast where we covered the arbitrage strategy, the Airbnb strategy specifically. As far as, 4 units and above or 5 units and above, but we'll use it for 4 as well. We use the economic model where we'll look at, the gross minus all the expenses, whatever's left is called net operating income. And you divide that by the cap rate, which I think we've explained that in the past. Yeah.
Also to note, I remember Sam, who was in the UK at the time, that's now in Australia, came across a 5 or 6 unit where they were Airbnb-ing each of the units and using the Airbnb value versus the actual rental market value for the asset. So again, making sure that whatever is there is repeatable, and in worst case scenario is going to be the value that the least amount of value that you can find for the asset as the buyer. Before the podcast started, you were saying, we don't buy like we sell, we don't sell like we buy. And it's 100% true. We want to buy for the best possible value. So we have a lot of exits. So if we do want to do Airbnb, we make even more money because we bought it right. Or if you want to turn it into some other boarding house or rooming house or whatever exit that you want, or because of the value of the land, it's actually better to scrape the land and develop it. That happens as well. It's worth a lot more. It's worth different things to different business models. And the question that you really have to ask yourself is, what's the cheapest business model that I can use to buy it? Then you have more exits in order to make the most amount of money, if that makes any sense. Yeah. So, So that's the point I want to add to that.
But and that makes sense. So just, buy it as a rental and you turn it into an Airbnb. Because if you're buying, especially a 6 unit and that's rented this way, that's like, it turns into like a small motel, right? When you think about it, the 6 unit that's done this way. And the question is not just, is the value justifiable, but is the actual business model sustainable? Because if it's not sustainable, then again, that's where you take a bath, and that's probably a big bath. So to go back to the valuation, like I said, you take the gross value of the income, you take you remove all your expenses, you're left with what we call net operating income, and then you divide that by the cap rate for the area, and that gives you a valuation.
Well, what about dollars per door? Because I know we've all heard this. Even in Vegas, we're buying this per door, or that per door, or dollars per key if you're in the hotel business, or price per square foot. All these things are thrown around. And Frank, I know you want to speak to that for sure.
Well, yeah. Well, the dollar per keys, they're looking at one economic value on similar asset classes, and it's still from a comparable versus. It's actually a comparable on the economic side, on the revenue side, how they get the doors. I mean, the dollar per keys or dollar per doors. And a lot of them are just used to doing that. I just wanted to touch back what you said, Gabe, on the best use. I noticed on a lot of appraisals, and by the way, I'm not taking a bath. I'm wearing my robe that these boys got me for my birthday. So in case someone's watching this podcast and saying, why in the fuck is Frank
wearing a bathrobe?
Wearing a Versace bathrobe on a podcast.
It's Hugh Galluccio.
Hugh Galluccio, yeah.
Hugh Galluccio, that's my nickname now. But these guys were very generous with me in Vegas for my 50th, so I do appreciate them. But going back to some of the appraisals that I got back, they have they even have a best mm-hmm. use. So they'll even look at, is that property best use as a long-term rental, an Airbnb, or maybe a rooming house like Marco would say, or maybe it's better to scrape the land and resurrect something else on there. So I just wanted to add on that they do look at that, especially appraisals and lenders, because they go, well, is this the best asset class on this land to maximize profits? So going back to the price per door, it's just in the realtor world, that's a common thing because that's what they look at. They look, okay, this property sold for X amount. Let's divide it up into the amount of doors or square footage, which is most common. But if you're looking at it from a economic or a revenue side of it, it may not make sense. Some people will buy a property that doesn't appreciate or it's low in value, but the revenue is high. So in places like, in the, I guess, Northeast, whatever, if you buy something in Ohio, they may not appreciate as much as other properties in other parts of the country. But people are okay with that. They'll buy for whatever, $200,000, and the appreciation rate is 0.0001, which is fine with them, but from an economic standpoint, the value is worth a lot more than the comp.
Because of the cash flow.
Because of the cash flow from a revenue perspective.
Has to be the price per door just doesn't make any sense because no two doors look alike. If inside the doors, that is. So you can have two identical buildings from the outside, both 6 units. If the left one is completely renovated and it's beautiful, just perfect. Yeah, it's an A plus condition, and then
A+, yeah.
And then the right building is in like C condition, basically original from the whenever it was built. Let's call it 1970. There's still 6 doors each. So if you're using price per door, then is it really fair? So
and location, what the rental market is, it's price per square foot, all that stuff. Yeah,
it's so.
But even what you said before on one of the students where we couldn't figure out why rents for this particular property were so much higher. Then we figured it out. Wait a second. He's not just renting a 3-unit or whatever it was. He was renting a 3-unit that was fully furnished. So now that's a business model that generates more money versus renting out 3 rooms that are completely empty and they got to bring their mattress and they got to bring their their dresser and their TV. So even that model, having the same 3 units or 4 units or 5, whatever it is, you furnish it, you're adding value. Now you're going from an economic scale where I'm making more money. So making more money, if someone's looking at the property from a revenue perspective, that property is going to be worth more, even though it's 5 doors.
It's going to be worth more to the person that wants to buy that business model.
Yes.
Right.
Well, yes. I presume if you're an investor, you're buying, to get an ROI, a return on investment. So
what if I have a hotel
that's going to hold
and
a lot of weight?
We've seen this deal come across our pipeline many times. It's a 22-room hotel, but it's rented by the hour, only by the hour. So people come in for 2-hour minimums and they charge $60 or $50 for 2 hours, and they turn that room 10 times a day, right? Or 8 times a day. I think my math is wrong there, but multiple times a day. So they're actually getting $200, $300, $400 a day for this asset that is not necessarily a sustainable model for someone that's not there every day. And I think we know why there's a 2-hour model there. If you put the pieces together, it's
because
yes, yeah.
No,
exactly.
Is it for the executives when they take a red eye and they just want to sleep for a few hours?
There's a place up the street from where I live that actually we were going to buy, and getting an asset-based lender to wrap their head around that model is very difficult on the refi side. So we had the cash available to buy it, but how do we exit? Because we're looking at our exit strategies as well. And this thing was like AIDS. No one wanted to touch it, because if that is no longer passed, or if they piss off the wrong person, then they change the zoning, which they can do, and say it's no longer going to be possible to rent other than nightly. There has to be someone that stays the night. There are areas where that's just how it is. Now in Japan, the hourly model is common. If you've ever been to Asia, it's very, very common. It's not always used as a brothel, but again, the person that owns it is not the pimp necessarily. There are strict rules, and the guy was extremely strict, and it was a very well run operation. Very, very well run, extremely, I was impressed just by the business model itself, but it takes a lot of time and a lot of, I guess, ownership involvement for that to happen.
And he wasn't included in the purchase, so
right. So the returns were like 40%, which is insane. But after you deduct who's going to manage it as well as the owner, very few people, and it's cash intensive, that walks away. So there's a lot of little things, and again, it makes a lot of money, but because it can't necessarily scale, it's not worth the same to us as the buyer as it is to the owner itself. So there's a value, I guess, a value differentiator. Or, exactly, thank you. That basically we have to first get on the same page as to what the value is, where we can then have a conversation around what the purchase price is going to be. Because if I believe that my property is worth $9 million, but using what it should be used as and not changing whatever the business model is, $2 million, I'm not buying it for $9 million. I'm buying it for well under $2 million. And we have to have that conversation first before we even start the conversation. So I think getting on the same page as far as value goes we were just having conversations prior to this podcast, which initiated us to talk about this now, is that's a conversation you have to have up front before you waste anyone's time, or yours specifically, because you don't have a lot of time left on this planet. If you look at how long the planet has been around versus how much time we have on this earth, it's a blip. It's a heartbeat. It's nothing. So you can't squander the time or someone else's by working on something that's never going to get you anywhere.
So to recap the value process, so anything that's under 5 units is going to be a comparable analysis. So if you're getting a seller who's selling you a 3 unit and using an income model to sell it to you, just, understand that that's how they try and get top dollar, and you want to use the comparables in order to make the right valuation. And anything over a 5 unit, you're using the income approach.
No, I was going to add, or a package of single families.
I wanted to,
where they're using income.
You want to go
I've
ahead?
seen that a lot, right? Where here's, I saw a package, I think it was 86 single family houses. The value is, this huge number. It makes X, Y, Z. Here's the net number. And, this is a steal. Everyone gets all excited over it. And they're using the income approach, which is what you just said, versus, well, what are the comparables? They're selling this for 3 times more than each property is worth. These are not best areas. And if I had to sell, if I have to exit quickly, which is why we want to buy it right. So if you buy it at 30% off every single time, it's going to be worth at least double within the next few years, just because of inflation alone, not even raising rents. As at the rate inflation is going, you're leveraging debt, real estate debt, not your own debt. You don't have to personally guarantee any of these things. And it's an asset-based loan, not a credit-based loan. Doesn't matter what your credit is. So if you're buying it at, with 30% equity, that equity is all yours as it appreciates, plus whatever the income is, but that's not based on the value. Now if you need to sell because you need quick cash, you put it on the market, it's gone. And you still made a shit ton of money. So you're always positioning to buy it where you can exit quickly. But if you buy it for double its value because of the income, which, I think the first or the second day of the 3-day, I share a story of a couple from Singapore that bought this property at a 10% return, and they were thrilled with it until they realized that the person that sold it to them bought it for 15 and sold it to them for 80. And and they want and it's worth maybe 40. They've actually lost money. They're going to have to wait 10 years before they actually break even because of if they ever want to sell it. So anyway, that's, but then that's a sucker, because I can buy the house next door or the triplex next door that's for sale for $50,000 for $30,000 and make the same amount of cash flow and only have $30,000 involved. So my returns are going to be massive.
Yeah. Now, I was going to mention the same thing, so I'm not going to repeat what you just said on the single family portfolio. But okay, let's take it. I'm just curious now on your thoughts, gentlemen. So if you have something that's 4 and under, and the business model is Airbnb, would you be conservative and say, you know what, am I buying the Airbnb model, or I'm going to look at this 4 unit and see
so
what the long-term or market rents are, and I'm going to base it on that.
So the income
instead.
Approach, yeah. Oh,
actually, sorry, not 4, not 4. 5 units. 5 units. So forgive me. 5 units. Yeah, 5 units. So the income approach. No, it could have been until you brought that up.
I'm going to say
it's not a trick question no more.
So
a 5 unit. Forgive me.
Obviously
4 and below. We're going to look at comps.
Yeah.
First,
Marco.
However, if I see that they're underperforming, if I already have an Airbnb business, or I understand and I'm educated, so I have more skill sets, right? So I have little skill sets, I'll buy it for the lowest common denominator, and I won't get every deal that comes across my desk, period. Because my skill set is, this is what I should buy it for. Here's the safe zone. I don't want to get fucked, so I got to buy it for the cheapest price. Then there's the more skilled human that sees that they're actually underperforming based on the Airbnb model, that there's some optimization that can happen, and if they bought it even at full price, they can increase the revenue significantly. And because I understand the business, I'll still negotiate, but I won't be as aggressive as the beginner. Now, if I'm super, super skilled and I see, actually, if I buy this, raise it to the ground, I can build a superstructure. I can, because of the land that's there, I can create this, this monstrous high rise because of the location, and I already know it's zoned. Then it's worth even more money. I'll it could be worth millions, and they're only asking 300, but on paper, with comps, it's only worth maybe 100, right? So, based on your skill sets and what you can do with the asset is really where you need to communicate. Now, if you're a builder and you're playing with gazillions of dollars and you've been doing this a long time, just like what happened to us in Vegas, is there's an asset that we have that I presented to a private equity fund that has billions under management, and their position is we don't negotiate price because we don't care. If we save $1 million here, $2 million there, we already know what our margins are because that's in our PPM or what we're giving to our investors. They're happy with that return. And if we invest a lot of time negotiating, we're losing the opportunity that we need right now. So we're going to pay retail. They don't care because they already know if they pay retail, whatever the ask is based on what their formulas are, and if they're paying retail, they already know they're going to make millions because they're changing the operation or they're improving the property in some way and still making millions. So they don't want to invest the manpower or the risk of losing the opportunity that's in front of them so they can actually deploy the cash that they have. So, and that's a completely different series of skill sets. And most humans that are listening to this probably are in that world, like private equity fund space, right? So it's a vast difference in what you're going to do with the property and what your intention is as to what you're going to buy it for. But the more skills you have, the more money you make.
Yeah, absolutely. Actually, we were just discussing this in Vegas with Gabe, with my hotel, where Gabe has a group that's aggressively looking for land development, and they want to build, I think, medical facilities or ALFs, assisted living facilities. And the hotel that I have has a big chunk of land, has a good footprint of land compared to the brick and mortar building that's on it. It's making money, but then we were looking at it. Well, will it make more money if we demolish that and build a medical facility and take some money from the sale and maybe a little piece of the equity, maybe as a passive investor? Is that worth more than what it's generating now? So it's definitely worth looking at different models.
In Texas, there was a piece of property I bought really cheap.
And it could be worth more
when I sold it
on something else.
There was oil in the area.
You need the skill set for that.
The mineral rights. And I actually make more on the mineral rights than I do on the property that I sold itself, right? Mm-hmm. The profit's higher. So you can sell a property and keep the mineral rights all the time. So there's a lot of things that you can do that most people don't even think of. And again, it comes down to skill sets. The more you learn, the more you earn. And the more skilled you are, not only do you not need any money, but your playground is a lot higher. Just like Dr. David, who closed on a 600-bed, 338-unit assisted living facility, pulled out almost a six-figure check the day he bought it. And there are people on the ground now, and we're trying to figure out, are we going to flip it for millions of dollars right away? That's profit, by the way. Millions of dollars in profit because we bought it for less than $500,000. In fact, we bought it for less than $400,000, about closer to $300,000, which is bananas. And flip it to a private equity fund that will pay millions because that's what they do. They pay retail. They don't care. They don't care what we bought it for. They don't care anything. This is what we're going to do. This is where we're going to buy it, and this is how much money we're going to make. It's a science, right? So it's again, different series of skills, different experience, different access to cash. You just follow what you are, and how do I say this without sounding weird? Learn more, earn more. Stretch yourself, because you might think that you're actually playing with pennies, but you're actually playing with millions if you really know what you're doing without having to even worry about the pennies. It doesn't even matter. You were going to say something, Frank?
Yeah. I don't know if it was you or someone else, where they bought a piece of land off Interstate 75, which is a main artery that cuts through, the eastern part of the U.S. from north to south, where the land itself was, fairly cheap, and putting billboards up all along the I-75, and you get paid pretty, a pretty penny for having a billboard there, which is not even your billboard. They build the billboard, they pay the electricity and all that jazz. So I was just getting back to repurposing the property or the land or the asset, which makes sense because it was in the middle of nowhere. To put houses up or building, yeah, it'll look great, but there's no infrastructure there, so that's an A. But maybe putting a billboard there or satellite, mobile satellites up or whatever. So yeah, just thinking outside the box a little bit. Again, you need that skill set and just that thought process to say, okay, does it make sense doing it this way, or leave it as raw land and just put in a tower up or billboards or whatever the case is, or selling it to selling it to the hydro company, maybe, or to the government if they want to.
If you know what you're doing, and interstate or whatever, you can make a lot of
service
money.
station. Yeah, a wind farm.
The only difference between someone that makes
solar farm, same thing,
a month, and someone that never will see $1 million in their lifetime is skill set and application, and you just have to find the right human to help you get there. Gabe, I feel like there's something that you wanted to add to that.
No, not at all.
All right, cool. So so learn more, earn more. That's the bottom line. Anything can be, you can buy anything for anything, but if you understand the value play and the value ladder as to what it's worth now and how much it could be worth based on the different uses of the asset, you can do a lot. You can do a whole lot, So again, it's the more you know, the more the more you rise. So hopefully this was helpful. Appreciate you two gentlemen. And hopefully as a listener, you learned a lot and are inspired to learn more, because the more you know, again, the more you're going to be able to really take the information based on things that are selling. There's always opportunity. And the person that's selling, if they don't know what they could do with it, there's a huge upside that they're not aware of. You're obviously not going to necessarily share that, but you can buy it a lot cheaper than if you negotiate. If you understand how you have the skill sets to negotiate, you can really squeeze in some extra capital and extra equity by really helping and serving the seller by learning how to communicate better, which is all we do all day long. That's what we do every day. So as a listener, thank you so much. Like it, love it, share it. This is something you really enjoyed. Please comment, give us a 5-star review or 4-star or whatever you want to do, but we're looking for 2,000 5-star reviews. I don't think you can do that 1,500 times, but we're looking for at least as many reviews as possible to get us to 2,000 as quickly as we can. So guys, thanks so much. I'm so excited I can't even say thank you so much. Have a great day, guys, as a listener, and just write down a couple things, couple ideas that you're excited about, and apply those as quickly as possible, because it's not listening that's going to make you wealthy. It's doing one thing every day that builds your wealth brick by brick, and all it takes is just action every single day, because a little bit every single day goes a long way, just like going to the gym. A little bit, long way, and that's what we want, is your success. Thank you so much. Have a great day, and we'll see you on the next podcast. Bye for now.
If you like this episode of Big Fat Real Estate Checks, then show some love by leaving a comment and a good rating. Also, as a thank you for tuning in today, we've got a special free gift. The journey to passive cash flow for life starts by finding deals, and it's easier than you think. Simply go to getdealsbytuesday.com, enter your email address, and we'll send you a free quick start course called Deals by Tuesday. Even if it's 11 p.m. Monday night, this course will show you how to find discounted real estate deals by Tuesday. It's that fast and simple. Go to getdealsbytuesday.com and start your journey toward life-changing cash flow today. Thanks for tuning in, and we'll see you on the next episode.